Larry Shover, he's the Chief Investment Officer at SFG Alternatives. Larry, good to see you. We did see Wall Street dipping, all eyes on that payroll data. I know you were listening in to our previous guest. Do you think that there's any chance we could see this non-farm payroll read surprise to the upside?
Yeah, I mean, definitely there could be a surprise to the upside, but the fact is we need a beat of 250 or more or 150 or less to change the narrative, to change the course or the minds of the Fed. So anywhere within in there, they're expecting 215,000. A small beat's really not going to matter. And furthermore, I think people look deeper into the numbers and just the unemployment rate and the jobless claims. I mean, they're looking at things that affect our output gap and affect the slack in our labor market, as you know, is pretty severe. So when it comes to participation rate, quit rate, unemployment rate, minus people who've been out of work for more than 6 months, et cetera. Those are the things that the market really cares about.
Okay, we heard from U.S. Fed Chief Janet Yellen overnight. Did she touch on any new ground, there? Did she make any comments in regards to the jobs market?
No, I mean, I don't think she has. I don't think she's going to. I mean, she's definitely very data dependent, actually a lot more cautious with the slack in the labor market, something that she continues to reiterate. But again, I think the unemployment report is going to have to be drastic for them to change the narrative tomorrow.
And when we talk about the market in general, Larry, I mean, what do you think the path of least resistance is? Do you think it's still higher?
You know, I do think it's slightly higher. It just seems like so many people hate this market, and we get headlines every day, and the headlines aren't enough to change the direction or the mind of the market. I mean, except for that GDP number, which was an enormous miss. Mm-hmm. But we saw China's PMI that was no worse than feared. ISM number came out, which was good. Consumption number in the U.S., better than expected. Construction spending kind of flat. So nothing to really change everything. We're still seeing strong corporate earnings, robust corporate buybacks, et cetera, good M&A activity. It just seems like so many people are negative that I do think short-term the pain trade will still be higher.
Larry, it's Gaurav here from Sydney. Is there any indication that the huge cash pile that investors are sitting on, or the companies are sitting on in the US, is there expectations for that to be used in the coming quarters at all? Or is there any news coming out from the companies hoarding all that cash?
That's a very good question. We were just talking about that not too long ago with regards to Apple and the pile of cash they have stashed away in Ireland. But yeah, I do believe that is the safety net, but that's one reason why the stocks are staying as high as they are. I mean, these companies are sitting on just a boatload of cash, and perhaps if growth starts to stifle, they can use some of that cash. So yeah, that is definitely being talked about. And furthermore, when you look at equity implied volatilities being as low as they are right now, it kind of points to that fact that the least path of resistance is higher, and that companies still have piles of cash to use if things go sour in the second quarter.
Gaurav, if we have sort of a period of consolidation for the market, do you think, generally speaking, though, that will, in the end, be a good thing?
The markets have gone up a long way.
I think in the end,
a lot of people are saying...
I'm sorry, go ahead.
A lot of people are saying that we're back in bull market territory, which I'm not quite sure about. But sentiment is certainly much stronger, and there's a lot of activity, and we're even getting a lot of positive sentiment, much more than I've seen in the last few years. So if it's not a bull market, it certainly looks like one. Any pullback from here is probably a very good thing, because it does feel as though the market's got a little bit ahead of earnings, and it's probably a healthy thing for sustaining this very nascent bull market if it does pull back just a little bit.
Yeah, how do you feel about that, Larry? I mean, how do you think that the U.S. earnings that we've been seeing have really been sort of coloring in that view?
Yeah, you know, for me, what's concerning to me with the equity market is that it seems like it's not paying attention to the bond market, especially when you look at the yield curve. It bothers me a lot. I mean, the fact that we're flattening The fact that the 10-year yield is at 261, I mean, to me, that means either there's no inflation or there's no growth. I mean, we can't continually trade down here with a 10-year yield at 261 and march higher in the stock market. I'd be a lot more comforted to see the yield curve steepen, 10-year yield being 275, 285. But beyond that, it does seem like short-term that the pain trade is higher.
Larry Shover, thanks so much for joining us. Appreciate your time this morning.
You're welcome.
That's Larry Shover, Chief Investment Officer at SFG Alternatives.